Have you ever wondered how some investors seem to predict the stock market almost like they have a crystal ball? While no one can guarantee profits, big data is bringing us closer than ever to understanding market trends. Today, we'll explore how big data predicts stock trends and why it's transforming investing. Big data refers to the massive amounts of information generated every second, from financial transactions and social media activity to global news and economic reports. This data isn't just numbers, it's a treasure trove of patterns waiting to be discovered. Traders and financial institutions now rely on this data to make informed predictions, often in real time. So, how does it work? At its core, big data analysis involves collecting vast datasets and using algorithms to identify patterns humans might miss. For example, sudden spikes in social media mentions of a company can hint at upcoming market movements. If thousands of people start discussing a tech company's new product, algorithms can flag potential changes in the stock price even before analysts release official reports. Another way big data predicts trends is by analyzing historical market behavior. By feeding decades of stock prices, interest rates, and economic indicators into machine learning models, systems can detect recurring patterns. These models can then suggest which stocks are likely to rise or fall under similar conditions in the future. It's like giving investors a highly educated guess based on the collective memory of the market. Sentiment analysis is another fascinating application. Algorithms can scan news articles, tweets, and blogs to determine whether public sentiment toward a company is positive, negative, or neutral. This can directly influence stock prices, as markets often react faster to public opinion than to official financial statements. Imagine a sudden rumor about a company's CEO stepping down. The algorithm can detect the surge in negative sentiment before the wider market reacts. Big data doesn't just rely on social media. Transactional data from millions of trades can reveal which stocks are gaining attention, which sectors are attracting capital, and even which investors are making moves. Hedge funds and institutional investors now use these tools to build predictive models, sometimes executing trades automatically based on real-time data signals. Of course, big data predictions aren't foolproof. Market behavior is influenced by countless unpredictable factors, from political events to natural disasters. Algorithms can misinterpret signals or fail to account for sudden shocks. That's why these tools are best used to supplement human judgment, not replace it entirely. Successful investors often combine big data insights with their own expertise to make well-rounded decisions. Interestingly, big data can also uncover hidden correlations that aren't obvious. Data might show that a rise in oil prices affects airline stocks in a specific way, or that weather patterns in one region impact agricultural stocks globally. By connecting these seemingly unrelated factors, predictive models become much more accurate. The rise of artificial intelligence has taken this one step further. Machine learning models can improve themselves over time, constantly adjusting to new data. Every trade, every news story, and every market movement feeds the system, making future predictions more refined. Some of the most sophisticated AI-driven models can even detect micro-trends within seconds, giving investors an edge that was unimaginable in the past. Big data also makes investing more accessible. Previously, only large financial institutions could afford the resources to analyze market trends at this scale. Today, cloud computing and user-friendly platforms allow individual investors to tap into predictive insights once reserved for hedge funds. Apps can offer data-driven suggestions, alerting users when a stock shows signs of significant movement based on real-time patterns. However, with great power comes great responsibility. The abundance of data can be overwhelming, and misinterpreting it can lead to costly mistakes. Investors need to understand the limitations of predictive models and avoid blindly following algorithmic suggestions. Knowledge, experience, and critical thinking remain key in turning insights into profitable decisions. So next time you hear about a sudden market shift, remember, it might just be the invisible hand of big data at work, analyzing millions of pieces of information and guiding decisions behind the scenes. If you found this video insightful, make sure to subscribe for more content on technology, finance, and the future of investing. Turn on notifications so you never miss an update, and leave a comment with your thoughts on how big data could change the way we invest in the coming years.